Hey everyone, and welcome back to another video for today. So as you can see right now, the market is about to close when I'm recording this video, and contrary to what we've seen yesterday was red across the board with one tile green, which was Google Alphabet. We've talked about Google quite a lot in the last couple of days, moreover the Google I/O event and why the market was wrong when it reacted negatively during that day, and why I remain very bullish on Google's long-term future. And it's quite nice to see that finally the stock does get a little bit more respect, although at $170 per share, I still think that this is one of the cheapest, most undervalued names in the market. Now, in today's video, I want to touch a little bit on the big, beautiful bill that just passed and the companies, the stocks that got negatively affected by it as well. I want to talk a little bit about the upcoming, AR glasses from Apple in 2026. And Bill Ackman, Pershing Square, actually bought a new stock. It is my personal number one stock in my core portfolio. If you've been following the channel, you know what it is. And if you're new here, first of all, hit the subscribe button. Thank you very much. And second of all, it's Amazon. We're going to talk about all of that in this video. Hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up, quick recap of what has happened with the 10-year, 20 and 30-year treasuries today. At the start of the day, we were actually quite higher, which is why yesterday, on Wednesday, the markets were red, yields were going up, and so stocks are coming down because, usually you're going towards safety, and if that safety gives you 4.6%, or if you're looking at the 20-year 5% or the 30-year also 5%, then why not, right? Why not? This is pretty good. But now on Thursday, when the market opened, it does seem like we peaked at around 4.6% for the 10-year, and then went back down to 4.5, which again is still quite high. Same story here with the 20-year. We peaked at 5.17, closing here the day at just over 5%, and the same thing here with the 30-year. If you want more information about that, why is it bad and what the US should do to bring it down, I highly suggest you go watch yesterday's video. We also talked about FICO and the reason why FICO was down, or still is down. Moving on to the Bill Ackman Pershing Square, opening of a position in Amazon. So in their investor call, their CIO, Chief Investor Officer, Ryan Israel, did say the following thing. He emphasized the strength of Amazon Web Services, which hold a dominant position in the cloud industry with over 40% market share. He projected a bright future for AWS, noting that currently less than 20% of IT workloads are cloud-based, but this could rise to 80% in the future. This is also something that Andy Jassy actually said a couple of times in the last 2 to 3 years or so. Now, that said, I also think that with the rise of, cyber attacks, I do still think that a lot of it will stay on-prem and will not move to cloud, but remains to be seen. The retail segment of Amazon, despite being less profitable than AWS, was also recognized for its ubiquity and customer-centric approach. Pershing Square's decision to invest in Amazon was driven by the stock's price dip earlier in the year, which they attributed to concerns over a potential slowdown in AWS and uncertainties regarding tariffs, a bit like every other stock out there, to be honest. However, Pershing Square assessed the issues as temporary, and with Amazon share trading at about 24.5 times earnings, the lowest multiple in the company's history, they seized the opportunity to invest. The investor call pointed out that despite the high valuation multiples historically associated with Amazon, the recent price offered at an attractive entry point. Pershing Square confidence in Amazon's ability to navigate through the AWS slowdown and tariff impacts while maintaining a growth trajectory of over 20% in earnings per share was a key factor in their investment decision, and also said some positive things about Andy Jassy. Now, if you don't know, this is the Pershing Square Capital Management portfolio, 11 stocks, a portfolio value of just under $12 billion. Now, Uber right now is the largest position in the portfolio, so I do think that maybe Bill is watching my videos because remember, I bought Uber late last year in the 60s, low 60s. Turns out Bill followed that move. I like Google, Bill likes Google. Amazon is my number one position. Now they've got an Amazon position. Well, they should have listened when I said that selling Netflix was a mistake, but okay, I guess you can't win them all. Anyways, Uber is the number one position in the portfolio at 18.5% of the portfolio, Brookfield Corp at 18%. Then if you take the combined Alphabet positions between the two tickers, that's one that comes in at the third spot. Now the company that they did sell, they said they also sold Canadian Pacific Kansas City. They said they regret selling it. So, okay, if you sold it, why do you regret it? But then again, fine. If you're getting Amazon in the portfolio, I guess that's a smart move. Now, I don't know how much of Amazon they bought, if it's also a huge buy like Uber, although I do think that Uber back in the low 60s was a big buying opportunity. So we'll see. Maybe it's going to be just the replacement of Canadian Pacific, so 8.7%. Remains to be seen, but then all the rest here is Chipotle, Howard Hughes, Hilton Worldwide, Seaport, and Hertz Global. Hertz was also one of those weird positions that they took in the last couple of months, I should say. And here is what the market is expecting Amazon to do in the coming fiscal years when it comes to free cash flow. So free cash flow in fiscal 25 is expected to increase by 11.3%, then by 84% year over year in fiscal 2026, and then another 40% year over year growth in fiscal 2027 to reach $94.29 billion in free cash flow. And I mean, this was bound to happen if you were looking at operating cash flows for Amazon before they even turned, free cash flow positive. You were seeing how the core business was profitable. Then they basically flipped the switch, and this is what we're getting right now. Yes, there were 2 years of negative free cash flow. They are still investing quite a lot, but the core business is of course very profitable, and we're seeing the results right now. And I do expect it to become more profitable in the future. You also have here as well, I'd say, call options when it comes to Project Kuipers, which is a bit of a competitor to Starlink, of course, very early days. You have Zoox, so you have an optionality on the autonomous play there as well. Streaming side, advertising, healthcare as well. So yeah, that's Amazon for you, and that's one of the main reasons also why it's the number one position in my portfolio. Plus, it's been in the portfolio for, now 7 years. So I guess that's the result. Moving on to the One Big Beautiful Bill Act. Now that has passed the House and it's now heading to the Senate, and we'll see. We'll see if that passes. So right now, of course, maybe you might say, okay, yields are coming down. Well, yields were going up in anticipation of it passing the House. And now that it did pass the House and the details have come out, maybe it is unlikely that it will pass the Senate, and that's why yields are coming down. I'm saying this because this is basically, I'd say the headlines of that bill. It's, I think, 100 or 1,000 pages long or whatever. I mean, me personally, we're in 2025. Just give every AI company there, every LLM, one single job to do. Balance a budget, right? Balance a budget, make sure that revenues actually increase and spending goes down without breaking anything major. It shouldn't be such an issue. I also said a week or so ago that I think politicians should be the first ones to lose their jobs to AI. Because let's be honest, a career politician, unless we're switching to performance-based politicians, I really don't see why we should have career politicians if the results suck. But okay, that's just me. Anyways, let's talk here a little bit about that bill. So the bill makes permanent many of the individual and corporate tax cuts from Trump's 2017 Tax Cuts and Jobs Act, including the 37% top individual tax rate and estate tax exemptions. It also increases the standard deduction and expands the qualified business income deduction to 23%. It raises the state and local tax, or called SOLT, deduction cap from $10,000 to $40,000 for incomes up to $500,000, phasing out above that threshold. This is a major win for taxpayers in high tax states. Then, They introduced a one-time $1,000 federal credit per eligible child born between 2025 and 2028. It also eliminates income tax on tips, overtime pay, and interest on certain auto loans, fulfilling campaign promises. Now, I know there's already a lot of discussions about the eliminating income tax on tips, because let's say you go to your barber and your barber is saying, look, I'm willing to cut your hair for $1 only if you give me a $50 tip. Of course, he doesn't get taxed on the $50 and you only pay $1 for your haircut, but actually you're paying $51. So yeah, I don't know how this will work out, but fine. And of course, that $50 example is just that, an example. Moving on to the other parts, cuts to social programs. The bill proposes significant spending cuts to Medicaid and the Supplemental Nutrition Assistance Program, or SNAP, including faster implementation of work requirements for Medicaid recipients. It repeals or phases out many clean energy tax credits enacted under the Biden administration, particularly for solar and wind projects, while preserving some credits for advanced nuclear energy. This is intended to reduce overall cost, but has sparked controversy in the renewable energy sector. And of course, we're going to talk about these stocks affected by it. They will also allocate over $46 billion to revive construction of the border wall and enhances funding for military capabilities. And last thing here, they're raising the federal debt ceiling by $4 trillion to avoid a government default. I mean, you can keep on raising the debt ceiling by $1 trillion, by $2 trillion, by $10 trillion to avoid a government default, but maybe, I don't know, crazy idea here, maybe actually try to solve the underlying issue. Wouldn't that be something? And so a quick recap of the sectors and the stocks that are negatively or positively affected by this. So, negatively affected, of course, solar renewables, loss of subsidies and tax credits. Stocks already down double digits, the likes of First Solar. Actually, First Solar not by much, but Enphase, SolarEdge, and some others were down quite a lot. Wind and storage also down, and that's also a negative impact. Nuclear, select one. So I think Constellation was one good example. Positive impact there. Auto lenders, positive impact. New tax deduction for US assembled vehicle loans. US automakers, indirect boost from auto loans incentives such as GM and Ford. Managed care, negative impact. Cuts to Medicaid could reduce revenues. Discount retailers, negative here as well. Cuts to SNAP food aid may reduce low-income consumer spending. And then rate-sensitive stocks as a whole, also negative because, higher yields increases borrowing costs, which should pressure margins. And so on Thursday, you've had solar stocks like Sunrun, which was down 37%, SolarEdge down 23%, Complete Solaria down 21%, Enphase down 18.3%, and First Solar, the one where I keep saying the same thing, it is, I would say, best in class, if you want exposure to solar energy, only down 3.7%. Now, Enphase had a conference not so long ago, I think a week or so ago, and it said the following. The CEO stated that the changes could create problems for jobs and cause turbulence in the solar market because it is being done abruptly, talking about the tax credits, tax benefits. He mentions that approximately 40% of their business is cash and loans handled by thousands of installers. The company plans to fight against this and advocate for an intelligent, phased approach to phasing out the residential tax credits. Despite the short-term disruptions, the CEO expressed confidence that Enphase will maintain its market share due to its agnostic approach to different financing channels, lease, cash, loans. He also highlighted that lease providers who will likely become more prominent value high-quality assets with limited operations and maintenance, which aligns with Enphase products' strength. The long-term solution, according to the CEO, is innovation to reduce the overall cost of solar, making it less reliant on subsidies. So the message here that I'm getting is short term, yes, that's an issue. Longer term, it's up to the company to make sure that, they are the best business that they can be. Now, of course, more recently, as you can see, if we look at total revenue annually in the last 12 months, it's not like the tax thing was the start of the problem. No, they already had problems, and the problems was basically that it is expensive, and that interest rates are quite high, which is why you're also seeing that huge decrease between 2022, 2023, and then 24 and the last 12 months. Now, for First Solar, which is less of a residential facing business, here, if you look at total revenue, if you take the last 12 months, here, where do you see the business struggling? I don't see it. Of course, Enphase has higher margins and free cash flow margins, but revenue-wise, First Solar is, I think, a much stronger business, and it shows, right? Even in a high interest rate environment, this was a business that had no issues growing, as you can clearly see. And so to me, to play the Enphase, First Solar or whatnot game, as I've said from the start, my exposure to the energy sector is through Tesla and Tesla Energy, and that's doing quite well. I did not need extra exposure. Yes, I've talked previously about Enphase and First Solar, clearly didn't work out. Well, luckily I never opened a position. For both companies, I still think they're going to make it. Now, the price that you're going to pay for it is highly important. For Enphase, I've also said that I think looking for maybe long-dated options could be a better option, pun intended, than just buying shares right now, right? Look at maybe January 2027. I don't know exactly what the prices are, but I think looking far away would be a better option right now. Moving on to the last topic, which is Apple. So Apple is going to launch smart glasses in 2026. We already have today Meta with the Meta Ray-Bans. I personally own them and I love it, right? The price of it is great. It basically serves as sunglasses, which is, well, the point. Second of all, you can listen to music without having anything inside your ear. You can answer calls, you can take pictures, you can actually take videos, you can talk with Meta AI as well. Great, smart glasses. Now the next step, of course, is augmented reality glasses, something that, well, semi-augmented reality like we've seen with Google during Google I/O. So this was a report from Bloomberg talking about Apple's smart glasses. They're expected to include cameras, microphones, and AI capabilities, much like the Meta Ray-Bans. The glasses will be able to take photos, record video, provide translation, give turn-by-turn direction, play music, facilitate phone calls, offer feedback on what the wearer is seeing, and answer queries, but there won't be augmented reality capabilities included like what we've seen with the Google glasses. Siri will be a key part of the glasses experience, with Apple planning to improve the personal assistant ahead of when the product launches. With Apple targeting a late 2026 launch, work on the smart glasses has ramped up. Apple plans to produce large quantities of prototypes by the end of this year, giving the company time to test before mass production and a public unveiling. According to Bloomberg, an Apple employee said that the glasses are similar to Meta's glasses, but better made. The Meta Ray-Bans use Meta Llama and Google Gemini, but Apple will rely on its own AI models, which I believe are powered by ChatGPT, no? I mean, Apple Intelligence is powered by ChatGPT? I think so, no? And so let's see what happens. Of course, when it comes to quality, yes, okay, Apple can focus on that just like we've done with the Apple Vision Pro. But let's be honest, if those glasses cost $1,000, it's going to be a flop like the Apple Vision Pro, right? Nobody is going to spend $4,000 after taxes for a VR headset when they can spend 7 times less and get a VR headset from Meta, the Meta Quest one. Same thing with the smart glasses. If they don't price it right, it's going to flop. Yes, they're going to have the core Apple, let's call them Apple fanatics. Sorry, but it's true. They're going to buy it. And then you have the same people that bought the Apple Vision Pro just for the first week so they can talk about it on social media. And then you never see them again. And that's about it. But if you want to target the mass markets, you have to price those accordingly. Lastly, here, continue on the Apple subject. China's Xiaomi claims new phone chip rivals Apple at a cheaper price. Now, what was interesting about this report is this. Xiaomi is winning the battle on the pricing of its latest phone. The new Xiaomi 15S Pro starts at $764, making it eligible for a state-subsidized discount. Did you know about this? Did you know that you get a state-subsidized discount in China for phones? No wonder nobody can compete there. I mean, if everything's subsidized, then yeah, outside companies that might not get the subsidy will probably get screwed. But okay. This is significantly cheaper than Apple models containing the company's most advanced phone chip. The Apple 16 Pro starts at 7,999 won, while the iPhone Pro Max model begins at, well, let's call it 10,000 won, above the 6,000 won cutoff for a Chinese government discount for consumers. Okay, so I guess if Apple wants to be included, they'll just have to, well, reduce the prices, but it is quite strange that you get a state subsidized discount for phones. But anyways, that's all I've got for you in today's episode. Of course, if you enjoy this type of episode, leave it a thumbs up, subscribe if you have not, write a comment if you want to hear about something else tomorrow. Let me know down in the comment section below, and I'll see you all in the next one. Bye bye.